Sri Natarajan, explain to us how Jamie Dimon is selected and Daniel Pinto is selected a CFO that has enjoyed failure.
It is just an incredible career arc, Tom. If you look across Wall Street, it would be hard to find another resume like this rising to the topmost seat at a bank. Here's Jeremy Barnum, who started at JPMorgan back in 1994, armed with a degree in chemistry from Harvard College, was part of the pioneering group that was just starting out the credit derivatives market, the CDS market, had a big prop trading role and blew up, was fired from JPMorgan over it, went to another hedge fund, fired again, but then was lured back to JPMorgan, and since then has just been an incredible comeback story and is now the CFO of the nation's largest bank.
What does he bring there? I mean, you look at JPMorgan and you look at the whale and all the other failures, AIG and such. He brings prodigious mathematics skills with his chemistry degree, he brings grunt and all the heritage and that. But what is the specific skill Jamie Dimon wants from him as CFO?
So let's look at really the second innings of his career when he returned to JPMorgan, 2007, the same time, in fact, possibly the same day the two hedge funds at Bear Stearns were blowing up. Then came the 2008 Bear Stearns acquisition. He had a big role to play in it. He was a junior staffer then, but that's when his first interactions with Jamie Dimon started. Then making sure that the firm was avoiding all the pitfalls from the collapse of Lehman Brothers, the cleanup of the London whale trading scandal. He played a role. He played a role in that. In fact, the antagonist in that whole scandal was Blue Mountain, his former employer. And Blue Mountain also helped JPMorgan unwind some of his trades. He was central to that process. He was right in there trying to clean up that mess. Obviously, that got a lot of acclaim at the top rungs, and since then, his career has only been on an upward trajectory.
Sri, there's a cliche on Wall Street that if you lose $1 million, you'll get fired. If you lose $10 billion, you'll get hired, and you'll be sort of rewarded for taking big risks, even if they fail. Is that part of the story here, or is it a distinct tale of someone who brings incredible credentials?
It is different in that back in 2004, I don't think JPMorgan was losing that kind of money. Yet he was in what was a prop trading role. He was the head of their credit trading business in North America. This was a group that really operated like a hedge fund within JPMorgan. They used massive derivatives, cash bonds, and these were the derivatives markets was just taking off at that time, and JPMorgan was central to it all. But then came the blow up. Jamie Dimon had just joined the franchise with the acquisition of Bank One. He was the president, and he was responsible, or at least he was overseeing some of the restructuring of the fixed income unit. And he went out. But to JPMorgan's credit, they recognized what they knew, but they also recognized what they didn't know and had to bring back someone who had the immense expertise in the derivatives that still sat on JPMorgan's book.
They needed help. Gotta jump in, sir.